Assalamu alaikum. Welcome to lecture 41 of SBR Current Issues. This is the last lecture in your SBR, okay, that you will see on my playlist. So I have from lecture 1 till 41, okay. I've started with IS and then I finished it on IFRS, okay, starting with IS 1 and I finished it with IFRS SMS. Then the last lecture before this was analysis and interpretation, where I calculated ratios and everything. Now this is the last, okay. Current issues. Current issue is a question that you are 100% going to get in your SBR exam. Every year on every sitting, SBR has current issues, okay. Current issues is the oldie area in your SBR which often keeps changing, okay. It keeps changing every year. Every year they might delete something or they might add something new, okay. So let's go through the current issue for this year. This year means from September 2022 up to June 2023. You will be sitting for June 2023. Okay, so you can, this current issue is applicable till then, provided there is no any other changes for the next year. That is starting from September 2023 till June 2024. If there is no changes, we don't know till now. We have to wait for the textbook. Then you can use this lectures, this current issues. Otherwise, I will update for you. Don't worry. Okay. So starting with the current issue, okay, we are going to go through this in this lecture. How do we account for digital assets? How do we account for natural disaster? How do we account for climate change, global event, and going concern? Then we have materiality, management commentary, and development in sustainable reporting. Starting with digital asset. One digital asset that all of us know by now is cryptocurrency. At least you must have heard about it, right? Cryptocurrency is a hot topic now. What is cryptocurrency? Cryptocurrency is like your digital currency. It's your virtual currency, you can say. A currency that you cannot touch, but it's a currency. You can buy and sell with it. Okay? It's a virtual currency. Okay? But remember, cryptocurrencies have some features. Unlike your normal currency, okay? Cryptocurrency is not issued by central authority. Okay? It exists outside the government control. That's why there are issues. Okay? Even in terms of value, the market value is extremely volatile. It keeps changing. Okay, and mostly the investors who trade in cryptocurrencies, they are aiming for short-term returns. No one holds cryptocurrency for long term. Okay, why? Because value keeps going up and down. It's very volatile, so they can make short-term profit by keeping it and selling it, keeping it and selling it. Now, how do you account for it is the most important thing. Okay, we don't know what current issues will be given, but you have to know all the current issue, whatever is given. Beyond this, you will not be tested. Okay, you will only be tested on the current issue that is given in your textbook. More than that, you will not be tested, so don't worry. But you have to know the issues which is there in your textbook, which I have presented to you through my lecture. So if you are not reading your textbook, at least go through my lecture, at least go through this video, so that you know all the current issues, because I am going to cover all the current issues. Okay, first is cryptocurrency. Cryptocurrency do not fall under cash. That is according to IS 7. Why? See, in your exam, if they give you, how do you account for cryptocurrency? You should be knowing it. What are the things you don't? Before knowing the correctness, you should know what are the wrong answers, so you can eliminate. Number one, it's not a cash. Why? Because they cannot be readily exchanged for goods and services. With cash, what do? You can easily exchange it for goods and services normally, but cryptocurrency, you cannot do that. Okay. Moreover, because it's a virtual currency. Next, it's not even cash equivalent. It does not even qualify as a cash equivalent. Why? Because to qualify as a cash equivalent, it should be something that there is an insignificant risk of change in value. But cryptocurrency has a significant risk of change in value. Value changes very drastically. So risk is significant. If risk was not significant, then it would be cash equivalent. But here risk is significant. So cash, it's not cash equivalent. So it's not cash, it's not cash equivalent. Next, what about financial asset? Can you take it as a financial asset according to IS 32? No, it's not even financial asset. Why? Because investment in cryptocurrency does not, it's not an investment in equity or another financial asset. You understanding? For it to be financial asset, there should be a right to receive cash, that means a financial asset, or it should be an investment in another equity. But it's neither of these two. So that's why according to IS 32 it's not even financial asset. Third, yes, you can be safe to say it falls under IS 38, that is intangible asset. Why? Because cryptocurrency is a non-monetary asset without physical substance. It meets the definition of intangible. It is non-monetary and without physical substance. Okay, so now according to IS 38, okay, you can apply it as an intangible asset. You should know all the rules of IS 38 by the way. Okay, everything will be applicable for digital asset. That's how you do it. That means cryptocurrency. Now, what about the fair value? Every standard mostly deals with fair value. Mostly, every standard. That's why we are talking about fair value here. What about fair value? Fair value is very volatile. Okay, so if I use in cost measure, it's not suitable. You have to use fair value of cryptocurrency. Why? Because there are options. In an intangible asset, there is an option to use fair value and cost model. You cannot use cost model there. For cryptocurrency, I'm talking about. You have to use fair value. Next, where does the profit and loss go? It goes in profit and loss, not other comprehensive income. Why? Because mostly entities invest in cryptocurrencies to benefit from short-term changes in fair value. So any short-term gain and loss goes to profit and loss. Okay. Next. So we are done with cryptocurrency. It's easy. It's IS 38 and you have to choose fair value, and fair value movement goes to profit and loss. Those are the three things you need to know. I repeat, IS 38, you have to use fair value and profit and loss. Everything goes to profit and loss, the movement in fair value. Coming to the second, that is initial coin offerings, ICO. Initial coin offering is a way of raising finance, okay, through cryptographic asset. Okay. So here what do? Investors buy into this ICO and they receive a token in exchange. Okay. This is very similar to crowdfunding, if you know what is crowdfunding. In case if you want to know detail, you can Google it and check it. Okay. So basically this ICO, who uses it? Tech entrepreneurs. Okay. Tech companies use it very often. Okay. So here ICOs, you need to know that this is also very unregulated. Okay. Not like how you raise finance through a bank. Why? Because banks is a very lengthy process and it has too many regulations. But through ICOs, you can bypass all those regulated and a lengthy procedure. That's why tech companies, they opt for ICO. Why? Because tech entrepreneurs are the entrepreneurs who need a large amount of finance. They need the largest amount of finance, unlike any other company, unlike a supermarket or a grocery shop or a normal retail shop if you want to open. They don't need so much compared to our tech entrepreneurs. That's why tech entrepreneurs are mostly using ICO. Why? Because it's shortcut, okay, and it's not even regulated like banks. It's hard. It might be hard to get finance through a bank. You have to show so many documents. And tech entrepreneurs, what happens is tech companies usually face failures in the first 6 to 7 years. So it's hard for them to convince the bank to get finance because you cannot show a profit, neither you can show a cash inflow. Okay. So ICOs are the best for tech companies. Now, when an entity raises funds in this way, what happens? The receipt that you are getting, okay, it is recorded as a debit entry. The receipt of an asset, it's a debit entry. The problem is, where's the credit entry? What happens to the credit entry? That's the issue. Okay. Normally, what happens when you raise fund? Your cash might be debit if you're raising cash or cryptocurrency debit or Bitcoin. But credit side, what do you credit? So here are some things that they have suggested. Is it a financial liability? For it to be a financial liability, there should be a contractual obligation to deliver cash or another financial asset to the holder of that token. If it's not, then We'll see whether it's equity or not. How? Whether they're entitled to the payment out of the reserves, distributable reserves. Okay. This would qualify as equity if the reporting entity has no contractual obligation to deliver cash or another financial asset. You see, financial liability, contractual obligation is there to deliver a cash, but equity has no contractual obligation. Or a revenue. If there's a contract, okay, let's say if the recipient was a customer and if a contract exists, then it's a IFRS 15 revenue. You have to recognize credit as revenue. So either the credit could be financial liability or equity or revenue. Depending on the nature, they will give you. Or it could be none of it. It could be a provision according to IS 37. How? How? If there is a legal or a contractual obligation to the subscriber, then it could be a provision. Okay, but if there is no specific IFRS standard, okay, then what do you apply? If the entity says that it's not provision, it's not financial asset liability, it's not equity, it's not revenue, then what? Then you have to use IS 8. Okay, IS 8 applies. That is, through IS 8 you develop an appropriate accounting policy. Okay, this is, we are talking about the credit side of it. Okay, if no IFRS standard, then IS 8. Okay, and when you are making that policy, refer it to the conceptual framework. That means, what does conceptual framework talks about liability, because we are working on the credit side. Okay, next. So the similar accounting dilemmas exist for security token offerings also. Same like initial coin offerings, there's another word known as security token offering. Okay, here similar accounting dilemmas that exist for ICO exist for that also, where investors are issued a token representing a stake in an external asset. They are getting a token, and on behalf of that token, they are going to have a stake in an external asset like shares or bond. They are going to have a stake in that. Okay, it's like a security for them. Okay, now, so that's for digital asset. What about natural disaster? The way you account for natural disaster. See, natural disaster will have an impact on so many places. Okay, you have to know all the places. Number one, impairment. Okay, natural disaster, we know that it's an external environment which an entity does not have any control. So this triggers an impairment review to be done according to IS 36. Okay, any calamities, natural disaster, hurricane, all this. So in case through natural disaster, if your PPE, property, plant and equipment, is destroyed, you de-recognize that asset. You don't impair it. Okay, impairment means asset is still there, but if asset is completely destroyed, you just de-recognize it. You don't do any impairment. Second, according to IFRS 9, impairment. Let's say it's a financial instrument that has been impaired. Then what? Financial asset that has been impaired. So you have to see for it. If you are lending money to someone, and if the credit risk of the financial asset increases significantly or not. Why? Because natural disasters have a tendency to lead to a higher default rate. That means your financial asset becomes credit impaired. Then you have to use the rule of IFRS 9 for the impairment. I hope you know it, right? In case you forgot all this, you go back to IS 36, review it. Go back to IFRS 9 and see how impairment of financial asset is done. Third, IS 2. If natural disaster leads to any inventory damage, then use IS 2, that is inventory. Some remeasurement needs to be done for inventory, like from its cost to its net realizable value. Okay, you can even go back to IS 2 and check, which is a very small standard and a very simple standard. Okay, now second impact is insurance. We all know that we get insurance and all, right? Car insurance or so many insurance. So IS 37 says recognition of an asset is only allowed if insurance claim is virtually certain to be received. If you're virtually certain that you're going to receive that insurance claim, you recognize an asset. Okay, but remember, This is a high threshold of probability. It is based on some probability and recognition is unlikely. Okay, just based on probability, you have to be very certain. But if, okay, you have to be certain. If you're certain only you recognize asset. If you have a high probability, you still do not recognize an asset. That means contingent asset. But if an insurance payout is deemed probable, a contingent asset can be disclosed. You disclose. You need to know the rules of IS 37, by the way. We do not recognize contingent asset. We just disclose it. Okay. Third is additional liabilities. Like, let's say we have decided to restructure. So an obligation exists because of that, right? But remember, a restructuring, for an obligation to exist, two things should be done. The detailed plan have to be publicly announced. Affected employees should be made aware of it. If these two things are there, you can recognize a provision for restructuring. Okay, and when you're measuring this provision, only the direct costs from restructuring should be included, like employee redundancy. Why? Because only through that restructuring, let's say your employees will be made redundant. That's why you have to include it, recognize it. Then what about provision for environmental damage? Let's say there are provision. Okay, that means you have an obligation to repair the environmental damage after the end of the asset's life. Okay, or decommissioning provisions are there, where an entity has an obligation to decommission an asset at the end of its useful life. What happens? You need to recognize it, right? Why? Because natural disaster will alter the timing and the amount of the required cash flow. So you have to review all this. If you have a decommissioning provision already, now you have to review it again if a natural disaster strikes. Now, deferred tax, the fourth place where this will have an impact. See, deferred, because of the natural disaster, okay, it affects a company's ability to have a future taxable profit. You are more likely to have a loss than a taxable profit. So because of that, now you cannot recognize a deferred tax asset. Why? In case you forgot IS 12, let me review it a little bit, okay, to refresh your memory. To recognize deferred tax asset, you should have a future taxable profit. I mean, there should be high probability of you having a future taxable profit. Otherwise, you cannot recognize deferred tax asset. That's why having a natural disaster, you're more likely not to recognize a deferred tax asset. Okay, in case you forgot, go back to IS 12 and review that deferred tax asset part. Coming to the fifth, going concern. Yes, having a natural disaster can have an impact on your going concern also. Let's say your bank loans are more likely to get breached, bank loan covenant. Okay, then if there is any material uncertainty relating to going concern, you have to disclose this according to IS 1. That is presentation of financial statements. Otherwise, let's say if going concern assumption is not appropriate, you have to use some other basis on preparing financial statement, and you have to disclose that fact on what basis you have prepared financial statement, if not going concern. Now, accounting for climate change. So two things we have finished. Accounting for digital asset, which is cryptocurrency and initial coin offerings, are over. Then accounting for natural disaster, which has an impact on, I think, 5 to 6 places. Deferred tax, impairment, insurance, right? Now we are coming to climate change. For climate change, there is no single IFRS standard that deals with it. This is like same like natural disaster also. For natural disaster, we don't have a separate IFRS standard. Same for climate change. Okay, so companies must consider this climate related matters and global events when the effect is material. You still have to consider this matters, an entity. Why? If the effect is material on the financial statement. Let's say the effect of the climate change is material on financial statement, you have to include it. Now let's do a small question on accounting for natural disaster. Test your understanding. 1. Middleshop. Okay, so this is about a retail shop which has faced some issues because of COVID. Okay, I'm briefly telling you the story rather than reading detail one by one. You can read it right? Take your own time and read it to understand, but let me tell you briefly so that we can quickly go to answering this question without wasting a lot of time. So it's about a pandemic that has a negative impact on a fashion industry. Okay, now it is having an impact on various aspects. Okay, so I will highlight those things. One, so this is having an impact on IS 16 and they are using currently cost model. Okay, now because government have issued a lockdown and closure of certain industries in the country, so it's having an impact on the fashion industry. Okay, now let's see where else. Now even the website is functioning is poor and customer uptake is low. Okay, then if you see website is recognized as an intangible asset with a remaining life of 5 years. Why website? Because now they are selling online also, even though they are not selling so well. Why? Because customers are shifting to online now, from retail to online during this COVID shopping online trend. Okay, now they are even closing some larger stores also. Okay, they have some, but there are no firm plans. They are considering to close down in 2002, but no firm plan has been drawn up, and there is a significant operating loss. Okay, their debtors wish to provide for redundancy cost as well as future operating loss. You have to see whether it's correct or not. Can they provide? Then they have some bank loans which has to be repayable within 12 months. That's short-term loans. Okay. So now discuss the reporting, financial reporting implications. This is how you'll be tested in your SBR. They will not specify what is it about. The current issue question I'm talking about. This is how they specify implications on the financial reporting. But through the word COVID, okay, or it's a pandemic, you know that it is a natural disaster. Okay, it falls under natural disaster only. If you have studied your notes properly while going through current issues, you know it's a natural disaster, and this is a current issue. Okay, so natural disaster, it is having an impact. Before you answer this, you have to know what are the places you can talk about. It has impact on 5 places. First, impairment. Because of natural disaster, impairment. Then provision. Then insurance. Then deferred tax and inventory. Okay, so here about two things you cannot talk and about 3 things you can talk. Insurance is out because they have not mentioned anything about insurance, whether you're going to receive, you're virtually certain, nothing. And deferred tax also, they didn't mention anything about the tax, so nothing about this too. But about provision, about impairment and about inventory, you have to talk. These are the 3 things you have to include in your answer. Any natural disaster. Okay, these are the 5 points you have to talk about in different paragraphs. Let's say 3-4 paragraphs you need. Okay, so let's start with the impairment first. Let's talk about impairment. So impairment would be the first thing you will be talking about in the answer. How do you answer this? So you know that because of impairment, shops are closing down and all, right? So the closures are indicating it's an impaired, that shops are impaired. Okay, even if you see website, poor function and low use also suggests that website also might be impaired. So 2 things are impaired. One is shops. Why? Because they are closing. Second, even the website are impaired because low functionality. Okay, and low use. Poor functionality, I'm sorry, poor functionality and low use. This suggests 2 things. One is shop and one is website that has been impaired. But if you see this impairment, you cannot, when you're doing an impairment review, according to IS 36, okay, so you have to mention which standard? IS 36. Impairment review has to be done. Okay, on both of this, 1 and 2, both of this impairment review has to be done, website as well as shops. Okay, so what do you need for impairment? Two things: carrying amount. In case you forgot IS 36, please go back and check. You have to always remember impairment. It can come along any standard. One is carrying amount, one is recoverable amount. Okay, I'm sure that these two are not foreign words to you. Okay, you're familiar with it from IS 36 because long time ago we did IS 36. Remember? And now we are in the last lecture. Okay. Anyway, yeah. So it is unlikely that individual asset can be tested for impairment. Can you test the individual asset for impairment? Can you just test the website and shops? No. You have to test them as a part of CGU. It comes together. Because in that shop you're using website. They're in the same line of business. With that website alone, you cannot generate independent cash flow. You understanding? That's why it comes as a part of CGU. You have to test for impairment. Part of CGU means cash generating unit. Okay. So it will be tested as a part of CGU. Okay. So each store is a CGU. Okay. Each store is a CGU here. And any impairment, where will impairment go? Profit or loss. It's an expense. Okay. Impairment of assets will go to profit and loss. So this is about impairment. You can write in your own words. You have to write the answer in proper sentences. Make sure that you read the answers later on. Okay. Now you have my points. Second, this is first para. Second para will be about intangible assets. Why? Because they have mentioned that websites are intangible assets, which has been amortized for 5 years or 4 years. So second para would be about intangible assets. Intangible assets is which standard? IS 38. This is under second para you have to talk about. Okay. What did they talked? Here, 5 years. So website is like an intangible asset and amortized over a remaining useful life. So they have, you only have to talk about the useful life. Obviously website could be an intangible asset, okay, because you cannot touch them, no physical this thing is there, okay, but what can you talk exactly about the useful life? Okay, useful, remember, natural disaster changes useful life. You have to review it again, whether it's tangible or whether it's intangible. Okay, so this requires an annual review of the amortization period. Requires annual review. Earlier you must have said it for 5 years, but now because a pandemic hit, it might shorten to 1 or 2 years. You never know. So that's why it requires annual review of amortization period. Okay. If you see useful life currently is 5 years, but don't you think this is too much, right? So this suggests that useful life of the website is too high because you need replacement in the near future, right? So any change in the useful life, remember, any change in the useful life is dealt according under which standard? Let me see whether you can recall this or not. Anything change in useful life is dealt under IS 8. IS 8. In case you forgot IS 8, go back to IS 8 and check. That is changes in accounting estimates, accounting policies and error. So you need to understand whether this useful life is out of the three what? Is it an error? Is it a change in accounting policy or change in accounting estimate? It's a change in accounting estimate. Okay. Why amortization rates are? This is a change in accounting estimate. You need to know this. It's not a policy. It's, you have estimated change in accounting estimates. Depreciation rate or useful life or depreciation, the non-current asset are estimates. They are not policies. So change in accounting estimates, how do you deal with it according to IAS 8? Change in accounting estimate are dealt prospectively. Prospectively means you change the current and the future period. You do not go back and change current and future periods only. If it is accounting policy, then it is changed retrospectively. That means you go back today and yesterday. Now, coming to third para. Third para will talk about IS2. Third para in your answer. Stock. Okay, see, because customer demand. Okay, demand declined. What happens to the stock? Now, even if you have the stock, no one will buy it. That means you have a surplus stock, isn't it? You are holding a surplus inventory. Surplus inventory. How do you deal with it? IS2 says lower of cost on net realizable value, NRV, right? You hold them at lower of cost or net realizable value. So what do you do with the surplus stock? How do you deal with the surplus stock? You can dispose them. Must be disposed of. Surplus stock must be disposed of, or you can scrap them. What else? You can scrap them for zero proceed. Or you can sell them at a heavy discount. Okay. If you do this, you will see that your net realizable value is falling below your cost. But it's fine. Anyway, you have to choose the lower of cost and net realizable value. Okay. So any expense, you'll have an expense. Okay. Any expense on a remeasurement of inventories. When you're remeasuring your inventories, you might have some expense. You might incur some expense. So any expense on remeasurement of inventories, where will it go? Profit or loss. Everything goes to profit and loss. Okay. Now what else we are missing? Fourth para. That is IS 37. Provision. Provision. Okay. So can you recognize a provision here? Provision you can only recognize if you have a present or constructive obligation. Okay. But currently there is no obligation. Is it? No, you don't have any obligation. There is no obligation. First say according to IS 37 when a provision is recognized that there should be a contractual or legal obligation. But if there is no obligation, then you do not recognize. Okay. There is no obligation to pay. The redundancy. You have to give reasons also always. You have no provision to pay what? The redundancy. Why? Because there is no detailed plan. Remember? They said there is no detailed plan. Currently, there's no detailed plan in place. You see it's somewhere given here. They are trying to close down some stores. Okay. But no firm plans. Now, the directors wish to provide for this redundancy cost. But it's wrong. You can't provide for the redundancy cost because no firm plan is there. That means it's a restructuring, by the way, basically. You cannot create a provision for restructuring here because no detailed plan. Okay. Now, what else? What about the future operating loss? They are also planning for future operating loss also. Can you provide for it? No, there is no obligation for that as well. There is no obligation to pay redundancy and there is no obligation. Same wordings you can use. that you have used for redundancy. There is no obligation to incur the future operating losses also. Do you have an obligation that you have to incur this future operating loss? No. How? Because, okay, Middleshop, always mention the name of the company. Then you will, that means you are linking it to the case study. You have to. So because Middleshop could choose to cease trading or stop trading. By stop trading, they might not incur the future operating loss. You see, they can avoid. If you can avoid something, you have no obligation. So you can avoid these future operating losses by closing down. That's why they don't have to this one. Okay. So they do not have to make provision for redundancy as well as future operating losses. Okay. Now, the last para, that is fifth para, talks about IS1. IS1 is about going concern. So what do you think? What can you write about it? See, look at there is an economic downturn currently that Middleshop is facing. Economic downturn. So because of this economic downturn, your ability to pay gets affected. Okay. So they might not have sufficient cash. They might have cash, but they might not have sufficient cash to repay short-term debts. You see, they have some short-term debts that they told less than 12 months to repay its short-term debts, because currently there is an economic downturn. So in this condition, having a cash to repay short-term bank loans looks impossible. Okay, looks difficult. So that means you are uncertain. You are not saying it's impossible, but you are creating an uncertainty over going concern. Okay, there is an uncertainty over going concern. So if there's an uncertainty, what do? Disclose this. You have to disclose this uncertainties, okay, as a note to the financial statement. So going concern uncertainties must be disclosed in the notes. Where? In the notes to the financial statement. That's it. So any natural disaster or climate change or digital asset question comes, this is how you need to answer. Whatever you have went through in my lecture, only those points. Beyond this, you will not be tested. Don't worry. The next topic that we are going to go through is materiality. Okay. How do you apply the concept of materiality while preparing financial statement? So the definition of materiality is if you omit, if you obscure, or if you misstate, and it influences the economic decision of the users. Okay, just by omitting. Okay, if you keep it, the decision would be something else. But just because you've omitted, the decision changed. Okay, if the decision would have been same whether you omit something or not, that means it's not material. But if your decision would be different, way different, if something is omitted versus something not omitted or misstated, then that information is material. Okay, so now when you're assessing whether an information is material or not, you have to consider this. Number one, two factors, quantitative and qualitative factor. Quantitative factors means you see in terms of revenue, profit, assets, and cash flow. Whether it's material in terms of the revenue, profit, assets, or cash flow. There are some thresholds that are given, quantitative threshold. Coming to qualitative factor, you have to see materiality based on related party transaction. Unusual transaction. See, in the transactions where you have a very high chances of having unusual transaction means it's very material. Very material, something which is very material in nature. Okay, where you can get the highest revenue will have unusual transactions, are more likely to have fraud in that area. Why? Because it's very material. The amount is so big. You see, or geography. In terms of geography is very material, or wider economic uncertainty. Now, you have to make a material judgment when you're making a recognition, measurement, presentation, and disclosure, not just in measurement, as well as when you're presenting something, it needs to be material information. When you're recognizing something, has to be material. When you are measuring it, has to be material. Now, coming to recognition and measurement. Okay, here basically IFRS standard only tells you, specific IFRS standard tells you. Okay, so here when you are applying it, they only need to apply this recognition and measurement criteria in an IFRS standard when the effects are material. For presentation and disclosure, when the resulting information is material, you need to include it, you need to disclose it. And when you're organizing information, entities should do this. You have to emphasize the material matters first. Second, when you're ensuring material information, do not put immaterial information there so that material information get lost. Third, information has to be entity specific. Okay, not general. Fourth, keep it simple and concise to the point. But don't omit material detail while doing it. Ensure your formats are appropriate and understood by the users. For example, you can give tables, you can give lists, you can give narratives. Provide comparable information. Okay. Then avoid duplication. Coming to users. When you are making a material judgment, see who is the user, who could be the primary user of that information. Okay. Now, primary users are basically your lenders and creditors, investors, lenders, and creditors. These are the three primary users for any industry. There could be others also, but for any industry, these three are very common. Lenders, your creditors, and your investors. Then, remember, when you're preparing information, financial statements cannot meet all the needs of the primary user. But at least common needs could be met of the users. Okay, there are some common needs, that means any stakeholder groups have common needs that are common among all the stakeholder groups. Those needs could be met. Okay. Now, this is the process when you are making, this is a systematic process when making material judgment. In your SBR exam, you will not be asked about this process. Okay, this is while you're practicing, while you're working somewhere in the field, let's say in future, after completing ACCA, you are getting some job somewhere. You have to make some material judgment there. This process will work for you. Okay. Number one, step one, you have to identify an information that could be material. Second, you need to assess whether that information is material or not. Step three, organize it in a draft format. Once you know it's material, once you have analyzed it, assessed that it's material, organize it in a draft financial statement. And finally, review the draft financial statement. Step 4. Now, moving to management commentary from materiality. Okay, what is management commentary? See, management commentary is like passing comments. It's like some comments which could be useful for you. Okay, the purpose of this is, even in your SBR exam, this could be asked. Okay, during my time, it was asked. Management commentary, the purpose and all. One purpose is it tells the user, okay, more context through which you can analyze your financial position, financial statement, and financial position, financial performance, and cash flow. You can understand it more because it gives you more context, management commentary. Whereas just looking at financial position, financial performance alone, you will not understand so much. Why? Because they are just figures. But commentary is like narratives you are giving. Okay, some detailed explanation to those figures. Now, please understand it's not mandatory to prepare management commentary. Okay, maybe in the future they might make it mandatory. Currently, it's not. The purpose is it provides management's assessment, how managements have assessed the performance and position. Second, supplement. You see, it gives us supplement information that is presented in the financial statements, already presented in the financial statements. It just supplements the management commentary with these figures. Third, to explain the factor that can impact the performance and the future and the position, the performance and the position in the future. So, just looking at the management commentary, you can say that these are forward-looking information, something that can help you in the future. Now the elements. Okay, so to understand, these are the elements. Management commentary should include these things. Okay, to understand. Number one, nature of the business. What is the nature of your business? All these things, can you get it through financial statement or profit and loss account? No. This is why management commentary helps you here. It's like supplementary, additional information. Okay, nature of business. Second thing, management's objectives and strategies. Second, resources, risks, and relationships, and the key performance measures that are used to evaluate the performance of the entity. These are the elements. You need to know this, by the way. Okay, if in case management commentary is given, you have to know all the sides of it, the purpose of it, the elements of it. If it's not given, then you are saved, but what if it's given? Okay, now providing useful information. Okay, so when you're giving useful information in the management commentary itself, to be useful, make sure that you are providing it in a consistent manner, even if it's not voluntarily, sorry, even if it's not mandatory. If you are putting it voluntarily, make sure that you report it in a consistent manner. Why? So that later on you can compare over time. Okay, even management commentary, you can compare over time if you are giving it consistently. Okay, how well you have performed. Second, you need to be able to compare it with other entities. If, okay, you are disclosing the performance measures used by the industry, widely used by the industry it operates in. If you are using same measures that are used similarly by the industry that you're operating in, you can compare it with other entities as well. Okay, third, try to give non-financial information also, non-financial performance measure. Why? Because your financial reporting only gives financial results. So if you include non-financial performance measure in MC, it gives more information. And finally, don't give generic information. Give specific to the entity, specific information, so that information becomes more useful in MC. Now let's do a question. Test understanding 2. So this is about management commentary. Here you have to explain the nature of MC and the extent to which it has the qualitative characteristics of useful information, and you have to make your reference to conceptual framework. Remember, in your conceptual framework they have given you the qualitative characteristics. You have to link it with this to MC. Okay, I have copy pasted the answer for you. Okay, I'm not going to read the detailed answer, but I'm just going to give you the structure of the answer. Okay, so here basically this is copy pasted from what I've just explained in my previous slide, that to understand the nature, MC have to include this: nature of business, its risk, resources, key performance indicators, operation, their objectives. Okay, all these bullet points I've explained. Okay, but before this, give a definition of MC first, that it's a narrative report. Okay, to understand the financial, to assess the financial position and performance of a company. Okay, it is not mandatory. Okay, second point is that it's not mandatory, but you can give this information so that it becomes essential to understanding. Now link this to the conceptual framework. Understand the qualitative characteristics. There are 6 qualitative characteristics: 2 fundamental, 4 enhancing. What are the 2 fundamental? Relevance and faithful representation. And what are the 4 enhancing? These are fundamental. Enhancing are understandability, verifiability, comparability, and timeliness. That means consistency. Okay, so you have to basically explain this 6 points. How MC's emphasis on it, link this with the characteristics. That's it. Okay, so you can that means you can basically have 6 paragraphs to give the 6 points. Okay, it's up to you, but basically I would suggest that 1 point, 1 paragraph. Okay, so now we'll first talk about relevance. Okay, relevance. So this paragraph is about relevance. First we'll talk about fundamental characteristics, that is relevancy. Okay, they are giving forward looking information, and this is relevant. Why? Because based on this you can make decision. Okay, and also to enhance this relevance, what MC could do, include material information, include and don't include generic information, give entity specific. Okay, this should be avoided. Coming to qualitative characteristics, sorry, enhancing, okay, understandability. Okay, that means to maximize understandability, present MC in a clear and a straightforward manner. So that's done. Now second one is about comparison. So when you're giving the key performance measure, okay, use that which are widely accepted by the industry, okay, within your industry, so that it's easier for you to compare between two entities. Okay, and when you're doing it, make sure it's done consistently. Okay, that means when you're calculating and reporting this performance measure, do it consistently so that you can even compare year on year. Okay, so you see most of the points are done except the last, verifiability. So how can you verify? You can always reconcile, okay, the financial performance measure with the figures in the financial statements. That's how you verify. Okay, because now you have given an MC, you have commented that this is how the figures are done. So with those figures, you can see in your MC whether they are aligning or not, or whether they are giving two different contradictory information. For example, let's say your revenue is increasing, okay, and in your MC you are saying revenue is declining or revenue is not increasing. So you see it's contradictory. You can see like that. That's how you can verify your financial information with your MC. Okay, and by assessing this, you can include, you can see whether it's a faithful representation of the entity's financial performance and position or not by including all this. Okay, and let me tell you that this question, especially linking it to conceptual framework, is very common. So please accept this, okay, that you're going to get a question on conceptual framework. It could be embedded with MC, or it could be embedded with anything else also, materiality, or let's say your the current issue, that is accounting for digital currency or natural disaster or climate change. Your conceptual framework could be part of anything. Okay, so we have moved to the last part of this lecture, that is developments in sustainability reporting. Okay, now sustainable development means, okay, balancing local and global effort to meet the basic human needs without destroying or degrading the natural environment. That means you are going to be able to meet the needs of the future generation before you destroy or degrade the natural environment today. That is the meaning of sustainable development as a definition. Now, there are so many reasons why companies are opting for the sustainable development goals. Why? Number one, it is ethical. Number two, government funding increases extensively for those companies which are involved in sustainable business. Third, reduction in reputational and regulatory risk. Fourth, sustainable products and services are growing at an alarming rate. Short term profit based models, if you see, they are not so much relevant for today's investors. Okay, they are likely to collapse. Reporting. So what are the reporting standards and initiatives on this area? There are two standard. One is known as UNGC, the United Nations Global Compact. Okay, this is an initiative to support the UN goals. Okay, it encourages the COP report, that means communication in progress. Here they discuss all the practical actions that they take to implement the UN principles regarding human rights, labor, environment, and anti-corruption. You don't have to know the detail of this, just a brief understanding. What initiatives have been done. That's it. Second is GRI, the Global Reporting Initiative. Here they publish the most widely used standards on sustainability reporting and disclosure. Okay, so here entities are encouraged to give balanced report. That means both positive and negative has to be there regarding economic, environmental, and social impacts. Okay, it even encourages stakeholder engagement to make sure that information needs are met of each stakeholder. Okay, now Legislation. Many countries have certain legislation also to support sustainability reporting. One is Singapore. In Singapore, they have a Singapore Stock Exchange which has made sustainability reporting mandatory for listed companies on a comply or explain basis. That means if you don't comply, you have to explain them. Second is European Union. In European Union, certain large companies have to disclose non-financial information on employee diversity. Maybe in future, this could become mandatory. Like how your IFRS standards or IS standards are mandatory, sustainability reporting also could be mandatory in future. But currently, it is not. Okay, except in Singapore for listed entities. Now, IFRS Foundation. What has IFRS Foundation done on this matter? They have publicly recognized the importance of this sustainability reporting for entity stakeholder. For example, investors. Why? Because investors now want more information regarding climate change to make their decision. Second, banks. They are more focused on this climate related risk to assess the financial stability of a company before giving them loans. That's why IFRS Foundation, they have stressed the need for stakeholders to be presented with more consistent and comparable sustainability reporting. So these are the proposals that has been put forward. IFRS Foundation trustees, they propose to expand their objectives to enable the creation of a new board. Currently, we have a board that is IASB, that means International Accounting Standard Board. Now they want a separate board known as ISSB, International Sustainability Standard Board. So what is the job of this board? Their aim is to develop a global set of sustainability reporting standard. We have financial reporting standard, okay, International Financial Reporting Standard, IFRS, but we now want sustainability reporting standard also, internationally sustainability reporting standard, because we want to harmonize and streamline reporting in this sustainability area. Now let's do a question on this sustainability reporting before we conclude this lecture. Now, mineral. Okay, test understanding 3 mineral. Mineral owns a machine that is central to its production process. At the reporting date, the machine's carrying amount exists its tax base. Okay, the difference is because of revaluation of the asset. Okay, now it is unlikely that machine will be sold. Year end, they receive 10. In return, they must issue ordinary shares of 12-month time. Number of shares will be based on the quoted price at the issue that date. Now, two things. First, briefly explain how it should be accounted in accordance with IFRS. This means you should know the correct IFRS for this. Second, discuss the accounting treatment. Discuss why the accounting treatment could be argued to contradict the definition of the elements given by the conceptual framework. First of all, what is element according to conceptual framework? It is assets, liability, income, expenses, and equity. LE. I would call it LE. A stands for assets, L stands for liability, I stands for income, E stands for expenses, another E stands for equity. Okay. Now, so the answer is, first, carrying amount exists is tax base. Okay, there's a tax liability. Understand this. That means there's a tax liability when your tax carrying amount is more than tax base. Which standard deals with tax liability? IS 12, deferred tax, isn't it? So basically, you have to tell how deferred tax is calculated in writing, because they told briefly explain. They didn't say calculate. Now they gave you the figure. So you should be able to explain like this, deferred tax. Okay. So you have to start by saying because carrying amount exists is tax base. So you have to recognize a tax liability. How you recognize tax liability, you have to explain. You multiply the temporary difference by the tax rate. They will give you the tax rate. Temporary difference means carrying amount minus tax base. It is known as temporary difference. Tax rate, they will give you 20%, 30%, 10%, whatever you multiply. Okay. And where do you charge this tax? In other comprehensive income. So basically, you have to now, that part is over. This is first part that you have answered. Second part is regarding how it contradicts with conceptual framework. Before you understand contradiction, understand out of this 5 element, which element are we touching upon? Is it an asset? The deferred tax in this case? No. Is it a deferred tax? Is it a liability? Yes, it is a liability because it's a deferred tax liability. Is it an income? No. Is it an expense? No. Is it an equity? No. So it's a liability. So remember the definition of liability from conceptual framework. In case you forgot, go back to my lecture 1 because my lecture 1 starts with conceptual framework. Okay, this is the reason why I've started my first lecture on conceptual framework. Okay, now you see the connection first to last lecture. You need conceptual framework no matter what standard you are doing. Okay, so second para is about that. Deferred tax means you are applying the accrual concept. You are recognizing the tax effect on the same day or same period when the transaction occurs. Tax effect as the same as the transaction occurs. So currently they have no plan to sell the asset. Okay, that means there is no present obligation to pay the tax that arises on its disposal. See, when you dispose only, you are going to pay tax on that, no? Because you're going to have a profit. But if you're not selling that asset, you do not have a present obligation to pay the tax. But conceptual framework says for liability, there should be a present obligation. That's why you see, but you are recognizing a deferred tax liability, even though no present obligation to pay the tax on disposal. So it's contradicting. Can you see? That's why deferred tax liability does not meet the definition of the liability in the conceptual framework. This is how you answer. Okay. Second, just something has been done. Okay. So here, however, the board rejects this position. How? Because they say that increasing the carrying amount may result in future economic benefits. Okay. Otherwise, the carrying amount is overstated. And these inflows are subject to tax. Let's see. Fair value. See, there was a fair value gain. Okay. Because they told revaluation has been done. So because of this machine's fair value gain, what happened? Maybe this fair value gain could be due to you are selling the output for the higher price. Okay. So it increases your taxable profit also. Because now you're charging tax on a higher amount. Okay. So the board argues that tax is payable on the revaluation, irrespective of how the asset is used. To understand all this, you have to go back to your IS 12. When revaluation happens, how deferred tax is dealt with. Okay. Now, financial instrument. The second part to this answer. Okay. So this is regarding your presentation. Presenting it as liability or equity. Okay. So here you are giving the definition of a financial liability. Financial liability means contractual to deliver cash. Contract to deliver cash or financial asset or a variable number of entities own shares. Okay. Here the contract requires them to deliver as many of its own equity. Okay, as equal in value to a certain amount, because they told shares will be issued at a quoted price on that date. So according to IS 32, this should be classified as a financial liability. It goes by the definition. But an equity instrument is not a resource of an entity. And so this contract does not represent an obligation to transfer an economic resource. This means the financial liability does not meet the definition of a liability. Even here it is not going. The financial liability definition and the liability definition from the conceptual framework are not aligning. Okay. In case you need an understanding in the financial instrument, I'm sure you must have got confused in the financial instrument part. You need to go through this and you need to go through your IS 32 once again to understand the definition of financial liability and equity, the difference between these two. Okay. why it is a financial liability and why it is not going in line. So that's it. We have finished our last lecture on SBR, and let's summarize whatever we have discussed in this lecture. We have started with current issues. Three issues are there: digital assets. Under digital assets, there are two. One is cryptocurrency, one is initial coin offerings. Cryptocurrency, it is taken as intangible assets at fair value and recorded in profit and loss. Then we had ICO, initial coin offerings. Debit side is fine. Usually an asset is recognized. Credit side could be revenue, a financial liability, or an equity, okay, or even a provision based on what they have given information. Then we went to another uh, current issue, that is accounting for climate change. Okay. Then we went through natural disaster. Okay. For natural disaster, there are 5 places that has an impact: insurance, inventory, then impairment, going concern, issues, uncertainties, and one more is there, which I'm forgetting, I think. That is provision, deferred tax. Okay. Then we went through, yes, so natural disaster, going concern. Okay. You need to know how to account for it. Okay. Then we have materiality. You have to know, you have to make a judgment in measuring as well as presenting material information. Okay. 4 steps are there: identify, assess, prepare a draft, and then review the draft. Then management commentary. Management commentary is not mandatory, but it is a supplementary to your financial information. It's a narrative statement. Okay, and the useful characteristics of management commentary goes in hand with the fundamental and the qualitative enhancing characteristics of the conceptual framework for useful financial information. And then development in sustainability reporting. Okay, that is the International Sustainability Standard Board, the new board they are planning to create. So that's it for this last lecture for SBR. My job is over. Now is your job. Pick up your revision kit. Make sure you do all the questions. And some questions you might need to do more than once. Okay. And make sure you do the past paper as well. Thank you for watching, and I shall see you in my question series, right? The revision kit series, where I'll be doing the question and answer on SBR on a new playlist. So till then, take care and see you.